current liabilities here, right? So what is the ability of the company to fulfill its short-term obligations or current liabilities? That is captured through liquidity ratios. Liquidity ratios are financial indicators used to assess a firm's ability to meet immediate financial obligations and effectively manage day-to-day fiscal operations. So what are my immediate financial obligations, right? For example, short-term debt which we need to pay down this year, or there are some salary payables, or we need to pay some creditors, rent payable. All these are current liabilities. So does the company has the ability to pay its current liabilities effectively? That we capture through liquidity ratios. Liquidity ratios provide valuable insights into a company's capacity to fulfill short-term obligations, which is pivotal for financial well-being. Operational efficiency, they mirror how proficiently a company handles its working capital and cash flow. Liquidity ratios include current ratio and quick ratio. So primarily within liquidity ratios, we have current ratio and quick ratio. What is current ratio? Current ratio stands as a significant liquidity metric used to gauge a firm's immediate financial well-being and its capacity to fulfill short-term financial responsibilities. It is calculated as current assets upon current liabilities. So current ratio is equal to current assets upon current liabilities. So it is telling us how much current assets do we have to cover our current liabilities. If it is one or more, it means if it is more than one, it means that our current assets are more than current liabilities and we can easily fulfill our current liabilities through our current assets. Whereas if it is less than one, it means our current assets may not be sufficient to cover our current liabilities and we need to generate funds from somewhere else to cover our current liabilities. Current assets encompass cash, cash equivalents, accounts receivables, inventory, debtors, prepaid expenses. Current liabilities include short-term debts, accounts payable, and other obligations due within 1 year. So how do we interpret it? As we discussed, a current ratio exceeding 1 indicates that the firm possesses more current assets than current liabilities, signaling its capability to cover immediate obligations through its current assets. A current ratio substantially above 1, for example 2 or higher, may signify excess liquidity, but could also point to underutilized assets, right? So although we want this to be higher so that we can be very sure that current liabilities can easily be covered by current assets, but if it is too high, if it is 2, 3, 4, that means lot of our capital is stuck in current assets. Maybe we don't need so much of current assets as we have currently, right? So what we need to do here is we need to compare the current ratio of our company versus other similar companies within that industry, right? So for different industries, this ratio could be different and it's perfectly fine. For example, if you look at IT company or if you look at service-based company, you might find that the current ratio is higher. But if you look at, let's say, some other set of companies or some other industry which are lower on current assets, which have a lot of payables, for example, metal mining or airline industries, the current ratio could be lower, and that is how the industry operates, that is how that set of companies operate. So that's fine. So when we are looking at a particular ratio, we need to look at it in comparison of other similar companies, and then we can comment on it whether this company is doing well or not, right? So that means I cannot compare the current ratio of TCS versus the current ratio of Indigo. That would be a wrong comparison. They are into different industries. So within that industry, what is the current ratio? What is the relevant current ratio? And then we can do that comparison of companies within that industry. That is more logical, and that is how we should go about ratio analysis in general. It is crucial to recognize that industry benchmarks differ, necessitating a comparison of the current ratio against sector-specific standards. So as I mentioned, for different industries, the benchmarks could be different, the standards could be different. So that's why we need to look at the current ratio of companies within the same sector or the same industry, and then do a fair comparison of which company is doing better in terms of current ratio or not. Next liquidity ratio is quick ratio. The quick ratio, also recognized as the acid test ratio, stands as a pivotal liquidity measure that assesses a company's capability to satisfy short-term financial commitments without depending on inventory sales, right? So the quick ratio is like a stress test of current ratio. Yeah. So in current ratio, in the numerator, we were using current assets as the numerator, but here in the quick ratio, we are deducting inventory and prepaid expenses from the current assets. So what we are saying analysis of current ratio data could be that company has significant ability to pay down its current liabilities using current assets. In fact, we can say that it is much more than what the company may ideally need, right? So if it is closer to 1 or slightly higher than 1, that would be enough. But here we are talking about 7.8, 4.4, 2.9, 2.7 and 3, which is very high. So roughly we have 4 times the current assets. On average, we have close to 4 times the current assets as compared to our current liabilities. So maybe the company is holding up too much of current assets, too much capital is stuck in the current assets, maybe in the form of inventories or accounts receivable or other current assets than required. But again, we can do that comment, we can make that comment only after comparison of this company versus other companies in the similar sector, right? Let's look at quick ratio. This is current assets minus inventories. This is total current assets minus inventories minus prepaid expenses divided by current liabilities. So our current quick ratio is coming out to be 3.63. So as we discussed, this would be lower than our current ratio. This is the stress test of liquidity. That means even if the company is not able to convert its inventory into cash, that means the company is not able to sell its inventory and generate cash from inventory, even then the company has enough capacity to pay down its current liabilities. So next we have leverage ratios, also known as solvency ratios. These ratios tell us about what is the ability of the company to pay down its long-term obligations. Okay, what is the ability of the company to sustain in the long term. shareholders, what is the total amount of debt funding the company has, divided by what is the total amount of shareholders' equity. Total debt encompasses all long-term and short-term debts, including loans, bonds, and credit lines. So all of these forms of debt, all of these forms of interest-bearing obligations encompass the total debt amount we have, and all of the total equity would include company's assets after subtracting liabilities. So inside shareholders equity we have share capital, additional paid-in capital, retained earnings, other comprehensive income, all of this part of total shareholders equity. We can also calculate total equity by simply reducing the liabilities from total assets. Interpretation: a higher ratio indicates that the company depends more on debt for financing, which may suggest heightened financial risk, right? So the more the company relies on debt funding, the more risky it becomes for the company to sustain in the long term. As mentioned, when the economy is not so supportive, when the revenue generation is not at the same pace, or when the profits are not being generated at the same level by the company, in bad times, during the bad economy, it may become a problem for the company to service its debt. By servicing the debt, we mean paying down the interest, paying down the principal repayments as and when they become due. So this servicing of debt can become a challenge in challenging economy, and that is why we say a higher ratio indicates that the company depends more on debt for financing, which may suggest heightened financial risk. Conversely, a lower ratio implies a more conservative capital structure with less reliance on debt. So if the ratio is low, do we want the debt to be zero? May not be the case, because debt financing is relatively cheaper as compared to equity financing. So as long as the company is able to manage the debt, as long as they are able to restrict the debt funding to a very manageable level, which they can easily service, there is absolutely no issue with debt funding to that level. But a very lower ratio as compared to industry might suggest that the company is too conservative. So maybe they can long-term debt. So this is calculated as EBIT plus depreciation. Here we have added back the depreciation because it is a non-cash expense. So EBIT plus depreciation will give us roughly the amount of cash profits, cash operating profits the company has generated, and from those does the company has the ability to pay its interest expense and long-term debt principal repayments. That is captured through DSCR ratio. This ratio measures a company's ability to meet its debt repayment obligations. Higher ratio indicates a stronger capacity to cover debt service. Higher the ratio means the company has higher ability to cover its debt service, to pay its interest and to pay long-term debt. A ratio above 1 implies the company can meet its debt obligation. Lenders and investors use this ratio to assess the company's ability to service its debt and the associated risk. Depreciation is added back as it is a non-cash expense and it reflects the cash flow available for debt service. So adding back depreciation is done because it is a non-cash expense and it is not impacting the cash flows. So EBIT has already deducted the depreciation, so we are adding it back to make it more relevant in terms of actual cash flows available to service the debt. So let's look at the workings now. How do we calculate these ratios? First is debt to equity. So we'll look at total debt. Total debt can include short-term as well as long-term debt. This is our short-term debt plus this is the long-term debt. Short-term debt plus long-term debt divided by total shareholders' equity will give us debt to equity ratio. So it is only 2.3%. Yeah. So debt is just 2% of the amount of equity. If you see, the debt amount here is 89,139, whereas shareholders' equity is 99,43,835. So equity is a much larger amount as compared to total debt. So this is captured through debt to equity ratio. We can say into our warehouse or go down, right? There can be issue of uh, obsolete inventory, or we need to incur a carrying cost when we are carrying the inventory for long. So ideally, if you look at more lean operations, more effective operations, those organizations would be carrying less inventory, but they would be churning over the inventory much quicker, right? So the company doesn't want to store too much inventory and also not run out of inventory. So here a balance is required, that we need to have optimal inventory in our warehouse so that we can meet the customer demand. We should not run out of inventory when there is a customer order, and we should not be holding too much inventory, because then it creates a problem of carrying cost and inventory getting obsolete. So that optimal level of inventory is required, and which can vary from industry to industry. So this is the focus area of this ratio, inventory turnover ratio. It is calculated as COGS upon average inventory. Cost of goods sold represents the direct expenses incurred to produce or purchase the goods sold during a specified period. So what are the direct expenses? That is captured in COGS, and once we subtract COGS from revenue, what we get is gross profit. So COGS is nothing but the direct expenses incurred to produce or purchase the goods sold during a specified period. It is also the goods sold during the specified period. So we are not considering all the goods which we have produced. Okay, we are not considering the direct expense incurred for all those goods which we have produced, but only the direct expense for those goods which were sold during a specified period. What was the direct expense for those goods, right, which we sold in a specified period? Means if we are talking about one quarter, for that quarter only, what was the direct expense of cost of goods sold? So that would be becoming the cost of goods sold divided by average inventory. Now you look at it, it's a mixed ratio. What do we mean by mixed ratio? Is one of the items is from the income statement. COGS is part of income statement, whereas inventory is part of balance sheet. So that's why we call this as a mixed ratio, where one item is coming, numerator is coming from the income statement, whereas the other item, the denominator, is coming from the balance sheet. Now income statement is for a period, so and balance sheet is at a point of time, right? So that is why we are taking the average of the balance sheet item to make our company is operating at 100 receivable days, then that would mean that we are being too lenient with the customer. Uh, we are allowing the customer to not pay us for 100 days. That means we are losing out on that much time, because if we get the cash, we can reinvest it, we can use it for generating more inventory or for growth purposes. So longer duration, much longer duration than the industry average is also bad, just like too shorter duration than the industry average can also backfire. So again, it depends upon the industry we are talking about, what is the benchmark, what are other companies doing, and then we can comparatively comment on it or say whether the company is doing better or worse. Okay, so next we have accounts payable turnover ratio. Again, what is accounts payable? It is the amount we need to pay to our creditors. Yeah, so let's say we have purchased raw materials from our suppliers on credit, so that we need to pay back, that we need to pay, that becomes accounts payable, and it sits in the balance sheet as a part of current liabilities. Now, how quickly are we able to pay back? What is the turnover ratio that is captured through this accounts payable turnover ratio? Is a fundamental financial measure that assesses the efficiency of a company's management and payments of its accounts payable. It is calculated as COGS upon average accounts payable. Okay, so again, mixed ratio, that's why one item is taken directly from the income statement, which is for the period, and for the other item which is taken from the balance sheet, we have taken the average value of that to make it synchronized with the numerator, which is for the period. Cost of goods sold represents the overall expenses related to the purchase of goods sold during the designated period. Average accounts payable is the average value of accounts payable during the same period, typically calculated as beginning value plus ending value divided by 2. That's how we calculate the average. Interpretation is a higher accounts payable turnover ratio signifies that a company effectively manages and pays its accounts payable, resulting in shorter payment cycles and potentially enhancing relationships with suppliers. A lower ratio may suggest slower turnover of accounts payable, potentially impacting relationships with suppliers and cash flow. So again, how quickly should we pay? That again would be different from one industry to the other. If we are paying it very early, that means we are letting go of the cash very quickly, which we could have used for a few more days. So too less a value as compared to industry, or too high a value as compared to industry. If we are paying in much longer duration than industry, that would again be a problem for our suppliers, and they may not be happy supplying the raw materials to us. So as per the industry, as per the competitors, peer sets, we can evaluate this ratio, and based on that accounts payable turnover ratio, we can calculate account payable days or trade payable days or payable days. It is a vital financial metric that assesses the average number of days it takes for a company to settle its accounts payable. So how many days it takes for the company to pay its pay talking about equity. Yeah, so that's why in the numerator we are taking net profit as our numerator, because net profit is what belongs to shareholders, because we have already taken the impact of interest or debt out. So that's why whatever is left as net profit belongs to equity holders. Either we can distribute it as dividends, or we can retain it within the company for its future growth. That's the decision of board of directors of the company. But we can calculate return on equity as net profit upon average equity into 100. Interpretation: ROE indicates the percentage of net profit produced for each dollar of shareholders' equity. So using each dollar, per dollar of shareholders' equity, what is the profit the company is able to generate. A higher ROE suggests the company's efficiency in utilizing shareholders' equity to yield profit. A lower ROE may imply lesser profitability or less effective use of equity. So again, if we are doing a comparison within the industry, the higher this ratio, the better it is. So this is return on equity. Next we have is return on assets, which is an essential profitability ratio that evaluates a company's capacity to generate profit concerning its total assets. So now we are not just talking about equity, we are talking about total assets. What are the returns the company is able to generate using its total assets? One of the ratios, if we remember, was asset turnover ratio. So there we were talking about revenue upon total assets, but here we are talking about return on assets, and we are talking about profits with respect to total assets. So return on assets is net profit upon average assets into 100. Again, if you look at it, it's a mixed ratio, with the numerator being an income statement item for the period, and the denominator is a balance sheet item at a point of time. So we have to synchronize it, we have used the average of the balance sheet item, average assets, so that it also reflects a value for a period. So that's why it is calculated as net assets upon average assets, net profit upon average assets into 100. This is telling us what are the returns, what are the profits the company is able to generate using its average total assets. Interpretation: ROA indicates the percentage of net profit produced for every dollar of total assets. So for every $1 of total assets, what is the net profit the company is able to generate? That is captured by return on assets. A higher value signifies the company's efficiency in utilizing its assets to generate profits, and vice versa. Lower value may suggest lower profitability or less effective utilization of total assets. Next ratio we have is return on capital employed. Here we are talking about both debt and equity. Okay, return on capital, total capital employed, which includes debt as well as equity. So it is a fundamental financial metric that evaluates a company's ability to generate profit relative to the capital invested in its operations. Now, if you look at the formula, in the denominator we are using equity plus debt. That means total capital employed is the denominator. That's why in the numerator also we are talking about those returns, those profits which belong to both debt and equity. From EBIT itself, we pay to debt holders in the form of interest expense, and the remaining goes to equity holders as net profit. So on EBIT, both have the claim. So that is why we are using EBIT here, whereas in return on equity, we were only using net profit, because there we were just talking about shareholders' equity. So in the numerator, we were using only net profit, But here, in case of return on capital employed in the denominator, we are talking about both debt and equity, and hence in the numerator to synchronize it, we are using EBIT or return measure, which belongs to both debt and equity. Interpretation. ROCE signifies the percentage of profit generated for each unit of capital employed in the business, considering both debt and equity. Higher value demonstrates the effective utilization of capital to generate profit, highlighting the company's profitability. Lower value may indicate lower profitability or less efficient utilization of the invested capital. So again, when we are comparing these values, we should do it for particular to asset turnover ratio into financial leverage to get our return on equity. So this should match with this ideally, right? This was a direct way of calculating ROE, and this we have calculated through multiplication of three different ratios, and the answer should be same. So this is what we call as dew point analysis of ROE. Now we are seeing ROE is going up, but dew point analysis can now tell us why ROE is going up. Is it because of net profit margins? No, net profit margins have in fact gone down. Is it because of asset turnover ratio? Yes. Is it because of equity multiplier? Yes. So the major components of ROE going up are higher asset turnover ratio and higher equity multiplier. Asset turnover ratio going up is a good sign, because that means we are able to generate more revenues using our average total assets, which is positive sign. But equity multiplier going up, average total assets upon average shareholders equity, that is not a good sign, because that means relatively, proportionally, the company is relying more on debt financing as compared to equity financing. So that's why equity multiplier is going up, which can make the firm risky if debt goes beyond manageable limits. But for this company, we have seen that debt is well within limits, with a very high DSCR, with a very high interest coverage ratio. So debt is the level of debt is not at all a problem. So even if financial leverage or equity multiplier is going up, still we are per share, offering indications of whether the stock is undervalued or overvalued. So here we are comparing the current market price divided by book value per share. Okay, so what is book value per share? The shareholders' equity we have in the balance sheet of the company. If we divide that by shares outstanding, what we get is the book value per share, right? So according to books, according to the balance sheet financial statements, what is the value per share? That is the book value per share, and the value at which the stock is trading at, that is the stock price per share. So stock price per share divided by book value per share will give us the P by B ratio, and accordingly what we'll do, we will look at what is the average of the industry, what is the average of the similar companies, and then we can compare it with our target company and figure out whether currently our stock is trading at a much higher PB ratio or much lower PB ratio, and accordingly we can figure out whether it is overvalued or undervalued. One more point to add here is that price to book ratio is more commonly used in case of financial companies like your banks, NBFCs, where their book, where the balance sheet includes a lot of assets or liabilities which are priced at market, right? So the book value is giving a much clearer picture as compared to other set of industries where the book values do not reflect the current market price. Next we have is the dividend yield. It represents the annual dividend payment as a percentage of the stock's current market price, providing insights into the return on investments from dividends. So what is the dividend the company is paying per share value? Let's say TCS is paying 5 rupees dividend and the stock price of TCS